Hey, how's it going, everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about what I believe to be the key to all tax planning. So if you've been following me on the channel here for a while, you know that tax planning continues to be a topic that we do quite a bit of here, and it continues to be one of our most popular topics that we do here on the channel. So in today's video, I'm going to break it all down to something I think is relatively simple, probably the most important thing that we really need to understand as it relates to doing some of our future tax planning. And that is very simply understanding what our tax bracket is today versus what do we think that tax bracket is going to be in the future. And very simply, and how we're going to use this in our tax planning, is if we think our tax rate today is higher than what it's going to be in the future, then we're going to want to engage in things that are going to reduce our tax liability today, and because we're willing to pay that tax maybe in the future at hopefully what's going to be a lower tax rate. But if on the other hand we think our tax rate in the future is going to be higher than what it is today, then we're going to want to do things that are going to push more income to our income tax return today to better optimize that. So it really comes down to this very simple premise here. But what I'm going to get into today is we're going to talk about mapping out a timeline so we can really understand how that tax bracket may change a little bit over time. We're going to talk about how to figure out where you are in the tax bracket, and we're going to talk about some future changes that may be coming or probably coming to our tax rates. And then we're going to talk about things that we can control and then things that we can't control as it relates to working on some of this tax optimization. But real quick though, before I get into the content of today's video, if you're watching this and you think it sounds interesting and you'd like to learn a little bit more about what we do at Money Evolution, be sure to check out some of the links down in the description below. There you can learn about our comprehensive financial plan called Wealth Vision, or go to wealthvisionplan.com, or you can learn about our retirement planning program called the Retirement Time Machine. You can also go to retirementtimemachine.com to learn more about that. Okay, so the first thing we want to do is we want to create a little bit of a visual timeline so we can see maybe how our income is likely going to change over different stages that we may be going through in our life. This is actually something that we have here from our Retirement Time Machine program, where it just gives us just a tool to kind of map this out a little bit better. Here I've already kind of filled some things in here, so we have a spot for you. If you're married, we have a spot for your spouse as well. We can put the years across the top, and then we can fill in our ages. And the reason for this is because you and your spouse may not necessarily be the same age. You may be retiring sooner than your spouse, or your spouse may be retiring sooner than you. So what we want to do is we want to start to put different events on here, like retirement. And again, that may be that you retire sooner than your spouse. You may say you retire in 2025, but maybe your spouse works a couple more years, and let's say your spouse retires in 2027. We also want to look at some key milestones as well, like Social Security. Are you retiring before Social Security? Then, when does that Social Security benefit kick in? So if you have different ages, maybe your full retirement age Social Security kick in at 2030, but maybe your spouse's doesn't kick in until 2032. So you're going to start to map this and really kind of see what may be happening with some of your income. If you have bonuses that are coming up, you say, hey, you know what, our company's done very well. Maybe we're getting a big bonus in a year or two, or a stock option buyout. Those are all the different things that we want to put on here. We don't have room for it on here, but we're also going to want to look at down the road, what are your required minimum distribution ages? And remember, they just changed that at the beginning of 2023. So now, depending on what year you're born, it's either going to be age 73 or age 75 if you were born in 1960 or later. So you want to put this all on here so you can get a little bit of an idea of what may be coming in. Maybe you have a pension that's going to kick in at retirement. So there's something there. So maybe that kicks in a couple of years before Social Security benefits. Whatever it is that you have, you want to kind of map this all out. And then you also want to attach some dollars to this too, so you can see year by year, what are some of those monies that you have coming in, and that's going to better help you to understand, where you might be falling in some of those tax rates, both now and also into the future. Okay, so once we've kind of mapped out some of those key milestones and understand maybe a little bit more about how our income is going to change a little bit over time as we move through these different phases of our life, the next thing we want to do is we really want to understand a little bit more about where we're falling in the tax brackets today in 2023, but we also want to do some projections and see where could we be in the future based on some different assumptions and based on hitting some of those different milestones where we may have different levels of income. So basically comparing what our tax rates are today versus what we think they might be in the future. So up here on the screen, I have a couple of charts here. This is from our Retirement Time Machine program. It's one of our reference guides here, and it's for the married filing joint tax status. So on the left, we have basically the current rates for 2023 that again are part of that Tax Cuts and Jobs Act rates. But on the right-hand side, I have the 2017 tax rates that have also been adjusted for inflation. So they're in 2023 dollars here. We don't know what the future tax rates are going to be exactly, but we do know that the current tax rates are set to expire or sunset at the end of 2025. And in 2026, we're going to revert back to the old tax table, which is going to have some type of an inflation adjustment most likely on it. So we're giving ourselves a little bit of a comparison of what tax rates today are versus what they might be in the future, or what they might be at least with that other tax rate. So we can see what they may be with those different tax rates. Now, the biggest difference I think that we're going to see here when we compare the current tax rates as they are in 2023 versus what they were back in 2017 before the Tax Cuts and Jobs Act rates came in is we pretty much across the board, across all these different tax rates, have lowered taxes for pretty much every one of these tax filing categories here. But I think the biggest of these is going to be this 24% tax bracket, which for 2023 for married filing joint goes all the way up to $364,200. So if we compare that to our inflation adjusted 2017 rates, we can see that the 25% tax bracket only went up to $176,000. So about half of what it is today at 24%. So again, what's our main objective here with the key to all tax planning? It's what is our tax bracket today versus what is it going to be in the future? And I think understanding this a little bit is going to be very important, because a lot of us may think because maybe we're working and we have a lot of income coming in, and once we get into retirement, we won't have as much income coming in, that we're automatically going to be in a lower tax bracket in the future. And what we've shown in a lot of other examples is that a lot of people, that's not just going to be the case. There's going to be a lot of people that are going to maybe be in a higher tax bracket in the future, and this is going to be a big reason for that. We can see that kind of going back here, the 28% tax bracket, 4% higher than the 24 that we have today, goes up to just $269,000, and we go from there up into the 33% tax bracket by about $100,000 compared to what we have right now, which that 364 is only going to be taxed at 24%. They say only taxed at 24%. We'd all like to have all these rates a little bit lower, but you get the idea, is that this tax table that we have today is going to be much more favorable at these levels of income than what it's likely going to be when the tax rates revert back in 2026. So as you build that map and really understand how your income is going to likely change over time, this is the kind of thing you can really map out and see what is my tax bracket today versus what is that tax bracket going to be in the future. The big one in here that I really want to emphasize that you want to make sure you understand are the required minimum distributions. So for a lot of people, you probably spent your whole career saving money, putting money into 401k plans and IRAs. That's all money that has not yet been taxed. And so when you get into retirement, as you start maybe needing to take that money out for some of the things you want to do in retirement, the withdrawals, you're going to be taking that money out. It's all going to be taxable to that. Also, too, when you reach that required minimum distribution age, whether you want to or not, whether you need to or not, you're going to be forced by the IRS to start taking some mandatory distributions. So it's going to be very important to you as you start to build this out and really do some of this tax planning that you understand what is the withdrawal requirement that I have from my retirement accounts, what's that doing to push up my income, and then just as importantly, really understanding what that's going to be down the road at age 73 or 75 when those required minimum distributions kick in. So one of the things that we have as part of our comprehensive financial plan, also our Retirement Time Machine program, is even with the Retirement Time Machine program, we walk you through the steps to help you build this out inside of some software that we use, the eMoney financial planning software, so you can really see all of these different things happening. So we're going to help you map out your cash flow so you can see what the withdrawals are every year. Again, those withdrawals are going to be something that's going to feed into taxes. So one of the things that we have is this very simple chart that really helps us to understand visually what are our income taxes today versus what they are when we're going to be retired. So we can see Right here, this individual, this is a hypothetical situation here. We walked through some case studies in our course, but you can see they're working for 3 more years and they're a very high level of tax. We can also see here too, something I'm going to do a whole separate future video on, is understanding these low tax years and how do you take advantage of that, but then we can see what happens later as we start taking more withdrawals, as those required minimum distributions kick in, our taxes are projected in this example to go up. And that's really something that's very common. This is not an unusual chart at all. This is almost probably represents the majority of our clients and what their financial situations look like. So we're going to talk about some strategies on how we can alleviate that a little bit. And then we can really get into some of the fine details here, where we can actually see this column right here, which is our income tax base. And that's going to be the amount of income that's going to be taxed to us at our income tax rate, that marginal tax bracket here. So we can see, even though this person is working here, I'm going to try to really blow that up here as much as I can, they have $233,000, $247,000, $254,000 of projected income, even in these 3 years while they're working. So if we're targeting, for example, that 24% tax bracket, they still have, let's say, roughly another $100,000 that they could do to maybe, again, push some of that income towards today's tax rate, because in the future it's maybe likely that they're going to be in a 25% tax bracket or higher. So we can really kind of get into those details here, and we can also see too where that income tax is going to go. And so we have our income with those required minimum distributions and everything getting up into the mid 200,000 range and everything, and we can compare that to a chart that I created. Another part of our course is the reference material right here. We can see right here this 25% column right here. And so this is basically a reversion back to those 2017 tax rates with an inflation adjustment on there, so we can see what is the upper end of that 25% tax bracket likely going to be out into the future, out at 2030 or 2035 or 2050. And so you can compare that to where you're at right now in the tax bracket and see. So for this individual, they're going to be pretty solidly towards the upper end of that 25% tax bracket. So doing something like a Roth conversion or some of the things to push income towards today is something that might make sense, because we're doing it at 24% versus 25%. Not a huge tax savings, but it also is giving us some protection against some future tax rates and things like that that may come out. So these are some of the things we have in our course, but you can do a lot of this stuff just by creating that map and really understanding, again, what some of those different key pieces are going to be for your future and current income tax situation. Okay, now let's talk about how to put this all together. Let's talk about some of those things that we can control and some of those things that we can't control. So let's first of all talk about things that we can control here. And so when it comes to our situation, we can control where we save money. Okay, so for example, you could save money in a traditional 401k plan, something that's going to actually be reducing your income today. So if you think you're in a higher tax bracket today than you are in the future, that's going to make sense to do things like traditional. And then if you think you're going to be in a higher tax bracket in the future, then you may want to pay a little bit more taxes today by putting that money into a Roth 401k plan, for example, a Roth IRA account. So you're paying the taxes now, but you're getting tax-free growth and tax-free withdrawals as long as they're qualified out in the future at retirement there. So you could do tradition or Roth, and so those are things that you can do to kind of control that income there a little bit. You may have a deferred compensation plan at work, and that's something that could allow you to save something over and above your regular 401k contributions. Got to be a little careful about that, because a lot of deferred compensation plans have some a little bit tricky rules and everything. You do become a general creditor to your company in the case of doing deferred comp, which means if the company went bankrupt, basically you're a creditor just like everybody else that they may owe money to. So you want to only do that or consider doing that, I think, if you're working for a company that you feel pretty solid about their future, that they're not going to go bankrupt or something, because there have been people that have lost that deferred compensation if the company in fact declares bankruptcy there. But deferred comp can allow you to further reduce your current income, and then you can have that paid out in the future. But you want to, again, make sure you totally understand those rules. A lot of times you can have it paid out as a lump sum at retirement, or you could have it paid out over a period of time, maybe 5 years or 10 years to kind of stretch that out. And so you want to make sure you understand that. And a lot of times for some companies, once you choose that, you're kind of locked into that for for the duration there. You don't really sometimes get a chance to change that up a little bit. HSAs would be another thing. So your health savings account, that's another way you could further reduce your income. Big fan of HSA accounts because I think healthcare for a lot of us is going to be one of our biggest expenses. So that's going to be another way to reduce your income there a little bit. You also want to look at things that maybe are somewhat in your control, but maybe not so much, and that's going to be things like restricted stock. So you want to be looking ahead at what benefits you may have coming in from your company. So if you've been accumulating a bunch of restricted stock and every year that restricted stock is becoming a bigger portion of your taxable income, you want to understand how that works. That's something for our advanced Wealth Vision clients that we help people map out. We've got some very sophisticated tools within our eMoney platform that we can help map that out. So understanding those restricted stocks, and I mentioned it earlier, understanding bonuses as well. So if you think you're getting a big bonus, those are things that you could, hey, next year is going to be a big bonus year. Maybe I want to take more income this year and kind of look at things like that. Okay, so now let's talk about some of the things that we can't control. So we're just going to call this, we'll say no control here. And so one of the things we just talked about earlier was the tax rates themselves. And so as we said, the current tax rates that we have right now are set to expire at the end of 2025, and we're going to revert back to the old tax rates beginning in 2026. That is if no new legislation occurs there. But really, our tax rates today, and even our tax rates that we had back in 2017, at least from recent historical perspective, were actually pretty low rates compared to what we had decades and decades ago. So it seems like for the last 30 or 40 years, tax rates have been steadily coming down. Well, now with, let's say, $32 trillion of a national debt and deficits coming to Social Security and Medicare, and Congress's need to kind of enact some new legislation so we can keep those Social Security, Medicare benefits up, more than likely, in my opinion, a lot of people's opinion, I think tax rates in the future are going to be going higher. So we talked about comparing, let's say, a 24% tax bracket today to maybe a 25% tax bracket of what that may be when the Tax Cuts and Jobs Act rates expire. But really, they could just kind of inch all of those up. So the 25% becomes a 28, the 28 becomes a 31, and just get a couple extra percent out of each one of those. And that's going to change that dynamic a little bit there from, again, what our key tax decision is what is my tax rate today versus what is that tax rate going to be in the future. So those tax rates are going to be one of those. The other one we talked a little bit about here are the required minimum distributions. So this is going to be something very important to understand. Again, we do that in both our comprehensive financial plan, also the retirement time machine program. We do it through some software. You could build spreadsheets and things like that to kind of get some ideas of what those future RMDs are going to be. But it really is a somewhat complicated calculation because there's a lot of things going into it. Of course, the growth rate that you might be getting, how much you're putting into those traditional retirement accounts, and then at retirement, how much are you withdrawing, and then what are those likely balances going to be at the time you reach that age 73 or 75. And for a lot of people, those RMD requirements are actually pushing them up into some higher tax brackets. So that's very important to understand. Again, we use some software that helps us out with that. And then the last thing I want to talk about here is going to be what tax table you're using. And so we were using an example here with our married filing joint tax table. And so if you're married, that's obviously the tax table that you're going to want to use. There's some good tax rates there. But God forbid something happens to you or to your spouse, the one thing that happens is in the year after your death, you're going to switch from a married filing joint tax table to a single tax table. And what that's going to mean is that you're going to hit higher tax brackets at lower levels of income. So if you had collectively $1 million or $2 million in traditional retirement accounts, whether you and your spouse are both alive or it's just you or just your spouse, that amount of that required minimum distribution is not going to change at all based on the fact that there's one of you instead of two of you. It's going to be based on just the age and having that amount come out. So that then can change things quite a bit. So you need to be looking at that. I said last thing, but I said one more last thing is you want to be thinking about your beneficiaries as well. And so that's something that, for most people, if you've been saving well and you have a good retirement plan put together, eventually some of this money may be going on to your kids. So the last step in this whole process, and it shouldn't be the primary one, but the last step is should be thinking about, okay, what is our tax bracket? What's my and my spouse's tax bracket or my tax bracket versus what do I think my kids' tax brackets are going to be? And that can kind of start to come into play there a little bit, especially as you get up in years a little bit. If your kids are doing very well, they may be in a very high tax bracket, so it may make sense for you to push some of that income to your tax return, maybe do some Roth conversions and things like that, instead of them getting hit with some higher tax rates, at their bracket and everything. So those are things you want to look at. Could be the opposite too. Maybe you're in a higher tax bracket than your kids, so you want to maybe do some things that are going to continue to defer those taxes, and they can pay those taxes at whatever their lower tax rates are going to be. Okay, so as I wrap up here, I want to talk about just one last thing that I think is one of our biggest tools that all of us have that we can use to shift income to today versus the future. And that's something I've obviously talked a lot about on the channel here, but those are Roth conversions. And so we talked earlier about the ability to change up where we're saving money, putting money into a Roth instead of traditional. That's going to have some little effects on our income that we're paying today. But the Roth conversion is really that opportunity that's going to let us do big chunks of money. So in that example we were kind of looking at earlier, where somebody maybe has $100,000 of room between where they are today with their taxable income and the upper end of that tax bracket, if you want to move over $100,000 at a time from a traditional retirement account to a Roth retirement account, the Roth conversion is going to be that primary way to do that. And if you've been following the channel here, I've got a whole lot of other videos about Roth conversions, so be sure to check some of those out there. But anyway, well, that's basically what I have for today's video. That's what I believe to be the key to all tax planning. It's really understanding what that relationship is between your current tax rates and what your future tax rates are. And I know that sounds relatively simple, but there's really a lot of things that go into it. So having a good solid plan is going to really help you to kind of figure that out. So anyway, with that, be sure to check out some of those links down in the description below. Check out some of our free resources that we have, our retirement financial plan, and our retirement program, the Retirement Time Machine. And with that, look forward to seeing you back in one of our next videos. Have a great day.